All right, this video is about the Federal Reserve System. The beginning of this unit, if I actually have time in class, I will show these two videos. If not, then I will probably skip it. Module 26 is pretty straightforward with the structure of the Federal Reserve, so I will probably leave it alone. But generally speaking, you do need to know that the Federal Reserve is kind of not really, but kind of a government agency. Keep in mind that the president does appoint the board of directors for the Federal Reserve and the chairman of the board. The chairman of the board is currently Dr. Janet Yellen. She does have a couple of years left on her term. But keep in mind that anybody who is appointed to the board, they do have to get Senate confirmation, but then they are on the board for 14 years. Now, within the Federal Reserve System, we also have 12 Federal Reserve banks, and so these are our regional reserves. The members of the heads of those regional reserves are not president appointed. Those are actually chosen by the board of governors. So they will actually choose those. I will put these links to these videos underneath this video in Canvas so you guys can take a look at that. It gives you a good kind of heads up as far as how the Federal Reserve works and kind of goes through the explanation of that. But in this video, I'm going to skip that part. The other part that I wanted to talk about is functions of the Federal Reserve. So this is something I'm going to be talking about. So depending upon how much time in class I have, this may be in a capital or A if I skip that structure part. Okay, so the first thing is that the function of the Federal Reserve, the Fed is what we call a banker's bank. This is actually where actual banks go to do their banking. So when we want to go and, for example, have a safe place to put our money, we put it in a bank. We get loans from a bank, okay? We are going to write checks from our bank account. Well, the Federal Reserve is where a bank is actually going to go and hold their money, and they will get loans from the Federal Reserve, and they will have checks cleared from the Federal Reserve. So that's one of the big functions of the Fed. So, for example, the Federal Reserve Bank of Chicago is the bank for Indianapolis. We are in the Federal Reserve Bank of Chicago's district. So underneath that, for example, all of our local banks, PNC, Chase, Fifth Third, they could potentially go to the Fed Bank of Chicago and ask them for a loan if they would like, or have them hold some of their money for them. They are able to do that. The Fed is also the bank of the U.S. government. So while these three banks, for example, and all the other ones within the Chicago district go to the Chicago Fed, the government will also go to the Fed. They will also have their money stored at the Fed. The Fed also inspects and regulates banks, so they will make sure that banks are following rules, that they are not getting too risky with loans, those sort of things. This is a funny cartoon. It says, and then we told them to regulate, self-regulate. So they kind of regulate themselves, but you know, that's the way it works. They also provide stability to the system through liquidity to banks. What this means is that if the banks need it, they will give them loans. They will make sure that they have cash on hand. That's part of the function of the Fed. And then lastly, they will also conduct monetary policy to address problems in the economy. So the monetary policy part we're going to get into in a little bit, but the Fed will actually make choices about where we are in the business cycle. Do we need more money? Do we need less money? What do we need going on? So this one says, and this is where we adjust the interest rate. So it's got a nice big pipe full of money, and so looks like two guys are kind of like turning it on and off, which kind of is the way that works, but not really. Okay, so now what I want you to do is I want you to add this section to your graphing section. So I know it sounds weird, and you're like, monetary policy tools, it's a chart, why are we adding this to the graphing section? Notice it says add to graphing section, leave room for graph to be added later. So there are three main monetary policy tools that the Fed has. They have the reserve requirement, the discount rate, and the open market operations. So the explanation part, I want you in this column to be able to explain what the heck this means. In the expansionary column, I want you to explain what they would do to increase the money supply, and contractionary, what would they do to decrease the money supply. So take a minute, pause the video, fill out this chart comparing these things, and then I want you to come back. Okay, so hopefully you filled this out and looked at the reserve requirement is the required amount of money that banks are required to keep in their vault. So to increase the money supply, the Fed would lower the reserve requirement. To decrease the money supply, they would increase the reserve requirement. The discount rate is going to be the interest rate that the Fed charges to banks on their loans, and to increase the money supply, they would lower the discount rate because it makes it cheaper to get loans from the Fed. So then, therefore, the banks can make out more loans. To decrease the money supply, they would increase the discount rate, and if they increase the discount rate, that means that they can't get as many loans. So as a result, they can't make as many loans. And then open market operations, this is going to be the buying and selling of treasury bonds. So to increase the money supply, the Fed would go and buy up treasury bonds. And so the reason this increases the money supply is because in order to buy up the treasury bills, what would happen is that the Fed would actually put more money into the banks or into the hands of the consumer, and so it would increase the amount of money that it's out there. So if it's in the hands of the banks can make more loans, for example. Whereas a contractionary monetary policy, they would actually go and sell treasury bills, because what would happen then is that the Fed would be taking, in order to pay for the treasury bills, they would be taking money out of circulation. So that means it's less money that the bank has to loan out, as well as it's less money that individual consumers out there have in hand. So that's kind of how it works. Notice I did not fill this out, so hopefully you filled it out. I'll have you fill it out in class. Now, the only reason I'm continuing on with this video is because I did have this. How does open market operations actually affect the T accounts? Now, you'll notice that there is an added T account over here for the Federal Reserve. The Federal Reserve has their own T account. So before we talked about the assets and liabilities of a commercial bank. For a Federal Reserve, you can talk about the assets and liabilities of the Fed. So the assets of the Fed include things like treasury bills, because what happens is that the treasury bills are going to be money that the government debt that is owned by the Federal Reserve. So they are actually going to be owed money when they own a treasury bill. And the liabilities of the Fed is going to be the currency in circulation, because the Fed is in control of how much money is in circulation. So they owe that money out there. They owe that. And bank reserves that they hold. So, for example, just like when we put money into our bank, okay, and it is a liability of our bank to make sure they pay us back, it's the same thing with the Federal Reserve. If we have, PNC Bank puts some of their reserves in the Chicago Fed, that's going to be a liability for the Chicago Fed because they owe that money to PNC Bank. All right, so I wanted to kind of quickly go over that before we talk about how open market operations actually affects the T account. So the first thing I want to go over is the purchase of 50 million in treasury bills. So if the Fed decides that they're going to purchase treasury bills, okay, so they're going to purchase treasury bills, what happens is that their assets, remember their assets included treasury bills, so that means their assets of treasury bills goes up by $50 million. But at the same point in time, their liabilities is also going on a $50 million monetary base. The monetary base, remember we already talked about, is going to be including the money in circulation and the reserves of the bank. So the reason that the monetary base goes up by 50 million is because they had to pay for the Fed had to pay for the treasury bills that they bought. So they have more treasury bills, but they created money by paying for those treasury bills. So either it's a case of currency in circulation that went up, or if they bought them from a bank, that's going to be money that they gave to the bank. So I know this sounds really weird, and you're just like, where did the 50 million come from? It's magic. It comes out of thin air. Okay, the Federal Reserve creates it to be able to buy up these treasury bills. But now it also affects the commercial bank. So now what happens is the commercial bank gets treasury bills as one of their assets, because that's, again, it's a claim on the debt of the federal government. Well, they had treasury bills, but now the Fed bought them. So they're down 50 million in treasury bills. However, their reserves go up by 50 million. Okay, because the Fed had to buy them from the commercial bank. So the commercial bank gives them to the Fed. So they're down 50 million in treasury bills. The Fed gets 50 million in treasury bills, but the Fed has to pay for them. So they give the commercial bank 50 million and they put it in their reserves and they say, hey, look at that, now we can make more loans. And on the flip side, the liabilities don't change with the commercial bank. Nothing changes with deposits because in this case, we are buying the treasury bills directly from the commercial bank. Okay, hopefully that made sense. So keep in mind, the big sticky part here is that the Fed basically creates the money when they buy up the treasury bills. That's why buying treasury bills is going to increase the money supply. All right, so let's try the reverse. If we have a sale of 50 million in treasury bills, that means that the Fed is selling treasury bills to the commercial bank. So that means they're down 50 million in treasury bills for their assets because they sold them to commercial bank. But the monetary base is also down 50 million because what happens is that the commercial bank had to pay for those treasury bills with some of their reserves. So they have less reserves, so that means they have the Federal Reserve has a smaller monetary base. The commercial bank, on the other hand, gets more treasury bills, but they have less reserves because they had to pay for them, right? So there's less treasury bills for the Federal Reserve, more for the commercial bank because that's where we get transferred over. In order to pay for them, the commercial bank is down 50 million. And the monetary base is down 50 million. So, and again, the liabilities don't change. So this is why a sale of treasury bills is actually going to decrease the reserves. The bank has less money to loan out because they had to pay for those treasury bills. So they have less money to loan out, so it's going to decrease the money supply. Okay, hopefully this made sense. On Canvas, I am going to post a quick examples where you're going to have to go through some open market operations. So you can give that a try and see how that works for you. Let me know if you have any questions.